So let's begin. First of all, thank you for your time today. We're going to be covering CorpWorks, and we're going to be looking at the things that make it different from VisionWorks. And what I mean by that is that in all three programs, VisionWorks, CorpWorks, TrustWorks, portfolios are handled the same way. Rental properties are the same. A business within a corporation or within a trust is essentially the same as self-employed income in VisionWorks. In other words, the way a business operates is the way a business operates. So we want to focus more on setting up a corporation, adding the assets. Again, what you've already learned about VisionWorks applies to CorpWorks, and then connecting everything. So let's first of all start with CorpWorks. And I've opened up my little demo file, and I just want to review adding corporations. When you first start, you need to click the edit button to add the first corporation, but once it's added, then you click the add button. And I want you to notice that you can add corporations, joint ventures, and partnerships. And in the case of corporations, there's no limit to the number that you can add. So I want to go through each of these tabs. Generally speaking, they're fairly straightforward, so I'll just highlight the things that are a little bit different. And I want to remind you that if you click the Help button in the lower right corner, you'll get a general overview topic, in this case, about the General tab. And when you click See Also, you'll get step-by-step instructions, how to add a corporation, joint venture, or partnership, and so on. So the General tab is very straightforward. What type of corporation is it, holding company or operating company? And by the way, from a tax point of view within VisionWorks, that's actually determined based on the calculations in the tax return. The proportion of active business income versus passive business income determines whether it's a holding company or an operating company. From the point of view of importing into VisionWorks, we need to establish if it's a holding company or an operating company only because of the lifetime capital gains exemption. Doesn't apply to a holding company. So I think you'll find that these fields are all fairly straightforward. The incorporation date doesn't really matter as long as it's before the current date. If we go to the capitalization tab, I've already added 100 common shares for ABC, and you can see that the shareholder is Bill Smith. We'll come back to that. DEF in this file is an OpCo. It has 200 shares outstanding, and the shareholder, of course, is ABC. But what I want to do is just review a couple of the key things. So first of all, if we want to add any type or class of shares, then all we need to do is click the Add button, and you'll see that you can add common, special, or preferred. And when it comes to the class of shares, it can be plain through Z. So there's no limitation to the capital structure. What I want to do right now, though, is I want to add some preferred shares. When you look at the balance sheet for a corporation, if you see preferred shares outstanding, I'm going to suggest that the likelihood is that those preferred shares are subsequent to an earlier estate freeze. I don't think many private companies actually issue shares when they're being capitalized that are preferred shares. Most of the time it's common shares. So the likelihood is that it's a preferred share as a result of a previous estate freeze. So I'm just going to make this 10,000 shares. And I want to remind you as well that the issue price of the shares and the PUC will be the PUC that's transferred from the original common shares. So if originally the company was capitalized with 100 common A shares at $1 a share, and in the past the preferred shares were issued as a result of an estate freeze, that would mean that the PUC is transferred from the common shares is transferred to the preferred shares. So in this case, it would be 1 cent, giving a PUC of $100, PUC being the paid up capital. And all that really says is that whatever money was put in to capitalize the company originally, whether through common or preferred shares that were received in exchange for those original common shares, that money can then be taken out tax-free because it's the original seed money, if you will, and that's paid up capital. So if you do have preferred shares that were subsequent to an estate freeze, you'd enter them, but make sure you click this little button. You have to select previously issued due to estate freeze and the estate freeze checkbox. So you've got to click that twice. And then once that's being done, then these preferred shares actually will show up as a liability for the corporation. I'm just going to jump ahead to the shareholders key employees tab, and I want to add Bill Smith as the owner of those shares. So I'm going to click the add button, select Bill Smith, click OK, and then I can select the preferred shares and put in the 10,000 that he owns. So let's go back to the capitalization tab. The other thing I want to point out about the capitalization tab is that you have the ability to enter debt. And this is debt that was used to fund the company originally. In other words, in the original funding, I shouldn't say originally, at some point, but in the original funding, it might have been common shares that were issued, and also somebody could have lent money to the company, and the person who lent that money need not be a shareholder. And if there's a maturity date, then you would enter it. But otherwise, if there's no maturity date, and keeping in mind that corporations are perpetual, then what I would do is put in a date well in the future, 100 years from now, and then put in the actual month and day of the month anytime previous to the current month. So I'm using the beginning of the year. And the reason is we don't want to enter this maturity date and have this show up as a cash source currently. So I want to have the maturity date well in the future. And then what I'm going to do is make the term, let's say 101 years. So that would mean that 01/01/21/22 minus 101, that we're assuming that the debt was issued January 1, 21/21, so it doesn't show up therefore as a current cash source. And then we can put in, of course, the face amount. So we'll just make that $100,000, and I'll make the interest rate the prescribed rate. This will then charge interest, but that interest could accrue, or that interest could be capitalized. And I'm going to leave it as an actual interest payment so we can see it when we have a look at some of the output. So we've got our common shares we've issued, or we've got preferred shares that were previously issued. As a result of an estate freeze, we've now got the debt. And when we go to the shareholders key employees tab, I also want you to notice the ability to enter key employees. But first, we need to talk a little bit about adding shareholders. So before you go in and add a shareholder, what you need to do is make sure that the VisionWorks plan is set up, not in its entirety, only the about page, so that we've set up the existing shareholders. And the same applies if shareholders of this corporation are a trust. We don't need to fully complete the trust model, but we do need to complete the about page for the trust. And the reason is that when we click the add button, we're not going to click edit, enter new, and put in the shareholder's name. The shareholder's name is merely a text string. In order to have VisionWorks and CorpWorks connect, or TrustWorks and CorpWorks connect, behind names of shareholders, there's actually a little bit of code, and it's the code that links the files together, not the text string for the name. There could be many Bill Smiths, for instance. So before you can enter the shareholders, you want to click Import from VisionWorks, select the VisionWorks plan, and then import the shareholders. The same thing for a trust. You want to import the trust, and then when you click the Add button, those people or trusts will be available for you to select, and that's going to link everything. So notice that if your shareholder is a person in VisionWorks, that the list up here says person. But if, for example, it's a trust, then you want to select trust from the list, and then I'm just going to use enter new. We would normally be importing, of course. But the reason is that the shareholder details dialog box is different for a person, another corporation, or a trust. So you need to indicate the type of shareholder because of that difference in those details. The one other thing I want to point out, let's assume for a moment that Bill Smith and Sue Smith are both shareholders of ABC. They could well have the same type and class of shares, common A shares. In VisionWorks, there's a feature called auto withdrawals. Sorry, in CorpWorks, there's a feature called auto withdrawals where CorpWorks can communicate with VisionWorks, ask VisionWorks how much money it needs virtually each year of the plan in order to top up the bank account in VisionWorks so there's enough money in it to pay expenses. So we're talking, for instance, of a corporation that's a holding company that's eventually going to be used to help finance somebody's retirement. If both shareholders, Bill and Sue, own common A shares, the auto withdrawals feature won't work simply because what Bill requires given his expenses, what Sue requires given her expenses, can be different numbers. So CorpWorks would be trying to ship different amounts to both people, but they have the same type and class of shares, and that means that dividends that are paid have to be the same for each of them. You can't say I'm paying Bill Smith with his common A shares a certain dividend and Sue Smith with her common A shares a different dividend. They've got to be consistent across all types and classes of shares. So what you would need to do in that case is you would need to give Bill the common A shares, and even though Sue actually owns common A shares, you would have to class hers as common B shares for that auto withdrawals feature to work. So that pretty much covers everything we want to look at in general capitalization and shareholders, with the exception of key employees. So ABC, being a holding company, of course, doesn't have key employees. On the other hand, DEF, being the operating company that's owned by ABC, does have key employees. So again, what I need to do is import VisionWorks so that it's available, and then I would click the edit button, and I can now go in and add a key employee, Bill Smith. And also what I can do is if I have another key employee who's not a shareholder, Jack Jones, then I can click the add button, select enter new, and I could add Jack Jones then as another key employee. We'll just leave our key employee for now as Bill Smith. So once again, I just want to remind you that when it comes to importing shareholders, whether they're people in CorpWorks or trusts in TrustWorks, you need to set up the About page in VisionWorks, the About page in CorpWorks. Nothing else is necessary, but just creating the people and the trusts will then allow you to import them so that CorpWorks can be properly linked to VisionWorks. As far as how robust CorpWorks can be, One of my favorite things to show this is a corporate map that one of our clients sent. These two people own a holding company. That holding company owns all of these operating companies. The operating companies in turn have interests in partnerships. Then this shareholder owns another holdco that has opcos. And then you can see up here also has interests in different partnerships. So when the advisor was asked to do a plan for this client and all the complex circumstances that he had, the advisor wasn't sure if CorpWorks could handle this degree of complexity, and it was able to do that. So there is virtually no limitation on what you can do. I just want you to keep that in mind. Often other software has definite limitations on its capabilities. Settings are essentially the same as in VisionWorks when it comes to the general inflation rate, government rate, capital gains rate, etc. You will notice, though, that you do, for foreign source income, you do have the ability to put in a non-business tax rate and a business tax rate if there is any foreign source income. So let's go down to entries. The first thing I want to do actually is look at tax entries. And I want to look first at the balance sheet details. The retained earnings, so I'll remind you that if, for example, a company has earnings of $100 after tax, pays a dividend, let's say, of $50, and retains $50 that it could have paid, then it has, for that year, $50 of retained earnings. If the same happens the second year, then the retained earnings would be 50 plus 50 equals $100. So retained earnings are after-tax earnings earned by the corporation in the past that it did not pay out as dividends, and therefore that's available to be paid out in the future. As far as accounts receivable and payable and so on are concerned, these are all really designed for the balance sheet. And my recommendation to you is that you do not enter them. Accounts receivable and payable from a balance sheet are merely those for the last year. A balance sheet is created at a point in time. Not all of a business's receivables have come in the door exactly by the corporate year end, nor has the corporation necessarily paid all of its bills exactly by the corporate year end. So receivables and payables are merely used for accounting purposes for the balance sheet. If for any reason a client said, please do a balance sheet, then I would create a separate solution, add these features in, and then do the balance sheet strictly from that separate solution. Balance sheets are often, or accountants are often very creative with balance sheets, so I wouldn't necessarily rely on them for anything other than understanding the capital structure of the company, the retained earnings of the company, and of course, anything like the preferred shares that might be outstanding. So I would ignore everything other than retained earnings. When we go down to deductions, reductions, the small business deduction, of course, is now important for aggregate investment income. So that's available from the previous year's tax return, Schedule 7, Part 2, 740, line 745. So getting the previous year's tax return, I would suggest, is very important to do. If you don't have it, then the software will automatically use the current year value just to have something in there. When it comes to the ERDTOH and NERDTOH, we need to know what's carried forward, the dividend refund for the previous year. So once again, I'm going to remind you that for all of these input panels, what I refer to as static panels, where you're being asked for specific information, all you need to do is click the help button. Again, you'll get general overview help. And then when you click see also, you'll get step-by-step instructions. And in this particular case, it tells you exactly where to go on the previous tax return in order to get the values you need to, to complete those entries. Let's go down to assets. I want to touch very briefly on life insurance as an asset. Life insurance that's modeled here under assets are all the policies that have a cash surrender value. They are an asset of the corporation. Whereas if we go down to expenses and look at life insurance, all of these forms of life insurance are just an expense. They don't have a CSV. So just keep in mind that if you go to life insurance, don't see term policies, it's because they're located under expenses. Otherwise, you'll see that assets are very straightforward, as many portfolios as you want, rental properties. You can also have personal property. A corporation could own art, for instance, residence. General corporate assets are assets that really pertain to the corporation itself, as compared, for example, to an operating business within a corporation. And we'll look at this in a moment. If you've got multiple corporations where, for instance, ABC owns the shares of DEF, when you set up DEF on the About page and indicate that ABC is the shareholder, then the entry for ABC is going to be set up automatically. So just entering things on the About page will take care of all of this, but you could enter interests in private company shares, otherwise. Let's have a look at other assets. And while we're talking about private company shares, this button is used to create a very light model for private company shares. It's not intended to model a company that has some significance to the shareholder, pays out, meaningful dividends, has a meaningful value, and so on. The point of this light company is that wealthy people often have little side investments. Here's somebody with $20 million. Somebody has started a craft brewery. They say, sure, here's $100,000 to put towards your brewery. The value of the $100,000 within the context of the $20 million corporation is, very minor. And we don't need to get all the details about the craft brewery and its capital structure and everything else. We just really want to put in a value so that it shows up as an asset of the corporation, just for completeness. So the private company here is used for something that's very light. Otherwise, I want you to notice the ability to put in intercorporate loans and loans to shareholders, where you've got multiple corporations. This could prove to be, quite useful. Let's go down to DEF. It's the OpCo, so it's got businesses. And you'll notice the ability to add any number of businesses. Again, a business in a corporation is pretty much identical to self-employed income. A business is a business. The only differences are the rent, lease, facilities button, the commercial insurance button within CorpWorks, whereas in VisionWorks, these two buttons are the deduction for home office expenses and a deduction for vehicle expenses. But otherwise, it's essentially the same. So let's have a look at modeling an operating business. When you get a corporate balance sheet and income statement, which have to be filed with the annual tax return, what you're going to get on that income statement is a top line, which is gross sales. And then below that, you're going to get lines that represent expenses. You could, if you wished, go down to expenses and model things in detail. So go to marketing, add in things like travel or meeting and convention expenses or whatever it might be. Alternatively, what you can do is look at the expenses of the business, identify those that are fixed expenses, things like telephone and utilities, total up the fixed expenses, and then add them in here. And then you would be left with variable expenses, things like advertising and promotion, but these would be totaled up in dollar values, but then entered as a percent of gross sales. And the reason is very simple. You could have somebody who owns a business or operates a business, let's say a doctor who at some point wants to semi-retire, therefore the sales will go down, his revenues will go down. The fixed expenses, telephone and utilities, will remain the same, but the variable expenses, the number of cotton balls he has to buy, will go down simply because his sales are down. So by adding variable expenses as a percent of gross sales, it then gives you the ability to change gross sales and to have all the expenses adjust, or those that would adjust will adjust in the background. So you can take that very high level. It actually is a pretty solid representation for a company. But if you want to get into a little more detail, if you go to fixed expenses, click details, what you will need from the annual tax return is the Schedule 125, because it has all the itemized expenses. And you can see here that we've included all of those that are most common. And then you can also see there's the ability to take other and add some different ones and their line numbers if you wish. So you can go into detail. Same thing happens with variable expenses. You can go to detail and add details into those that are, again, most likely to be used. The one thing I will just point out when you are adding expenses for a business is if there are expenses that are not directly related to the business, marketing, for example, I would add them separately under corporate expenses. And the classic examples would be fees, specifically accounting and legal fees. So the business may cease to be an operating business. Now it may be a holding company, but the need to file an annual tax return will continue. So we want to have that accounting fee separate from the business expenses. The business income and expenses could end, but the accounting fees will continue because the tax return has to be filed every year. So I would just recommend some of the expenses that will continue after a business ceases its active operation be modeled separately. I want to go down now and have a look at solutions. Basically, the output is the same as in VisionWorks. In other words, we're on the Solutions tab. Above the graph on the right, we have the different buttons that control the look of the output. So we can click the expand button, see both the graph and the table, or we can switch, for example, to spreadsheet mode. And remember, we can expand that out to full screen view and then shrink it back. And then switch back to the graphical output if we wish. So these are all just straightforward, similar to VisionWorks. Again, within a corporation, instead of the term being net worth, the term is equity. I'm going to switch back to ABC, by the way. And of course, you've got net cash flow, and then the ability to drill in, look at sources and uses, and so on. So, things are essentially identical. The one thing that I do want to do, though, is talk a little bit more about the capitalization tab. So you can see here that we have our common A outstanding, and we also have our preferred shares. Notice the capital changes tab. So I just want to, by way of illustration, go in and say we're going to redeem those preferred shares over time. So I'm going to click the Add button. I'm going to select Redeem Shares. I'm going to select the preferred shares, and I'm going to put in a redemption date of 01/01/2023. We'll do this next year. We'll do 1,000 of our 10,000 shares that are outstanding. And notice that Bill Smith is the shareholder. Sorry, I put in 10,000. I want to put in 1,000 of the 10,000 shares that are outstanding. And then because I could have Bill Smith as a shareholder, Sue Smith, and so on, I need to indicate how many of Bill's shares are being redeemed. In other words, I could be redeeming 1,000 shares in total, 500 of Bill's shares and 500 of Sue's shares. So I would have to indicate the two 500 amounts. So this is the total redemption, and then how much for each shareholder who's listed in, or who appears in the list. So we've got our redemption now. And what I'm able to do is repeat that. So I could say after this year, I want to repeat it every year for the next 9 years. So we see the redemptions going on through 2031. But I want you to notice when I click save that the capital structure now shows the redemption of those shares every year down to 2031. And then at that point, there are no preferred shares outstanding. So you can enter capital changes, be they the redemption of the common A shares for the issue of the preferred shares, the issue of common B shares, let's say to Bill Jr., if this were an operating company and if we were performing an estate freeze. And when you go to the capitalization tab, you can see the changing capital structure. So I'm just going to get rid of all of these. Not edit, how about delete? And when I resave that, you can see we continue then to own the 10,000 shares. Let's just jump back to the valuation tab. The default valuation is equity, just, what's the company worth? But you can select different valuation methods. So a classic might be, for example, with an advisor, if incorporated, the advisor may not have much in the way of assets from a point of view of equity, would have a client list, which, would have value. But more likely than not, the advisor would be basing the value of the company for sale on a multiple of earnings. So you could select capitalization of earnings, put in the multiple that's being used, and so on. But our default is equity. The one thing I do want you to notice, though, is that the default entry for the value of the preferred shares is just picking up the PUC from the About page. However, at the time of the redemption of common shares and the issue of preferred shares, let's just say the common shares that Bill owned were redeemed for $100,000, and he was issued 10,000 preferred shares. What that would mean is that we would need to put in $100,000 divided by $10,000 or 10,000 shares to give us the per share value. So 10,000 times 10, 10,000 times 10 would then be the value of the preferred shares that he now owns. So just keep that in mind, that the About page is going to show the PUC, the paid up capital that can be returned tax-free for on the preferred shares. But when it comes to the value of the preferred shares, what we're doing is we're saying, what was the value when they were issued in exchange for the common shares? In other words, the common share value on redemption divided by the number of preferred shares that were issued. Because that, of course, is going to show up on Bill's personal balance sheet when the shares are imported into VisionWorks. Next thing I want to do is look at dividends. So in the background, the company is, CorpWorks is tracking the different dividends. If we go to DEF, for instance, you can see there are no CDA dividends. The reason is everything is being dividended up to ABC, the holdco. And similarly, there are no eligible dividends, no investments to earn those. And then when it comes to the ordinary dividends, now we can see the value of the ordinary dividends through the period of the operating business. After the operating business ends, we no longer, have the dividends, ordinary dividends to be paid. So we can go in then and dividend up I've done that for DEF. And now when I go to ABC, now I have the amount of money in ABC that's available for dividend payments in the future. And you'll notice that it's whatever was paid up to ABC from DEF, plus I've included the retained earnings. And then also that coincidentally is the cash on hand. Just keep in mind that the cash on hand does not necessarily reflect the retained earnings plus any current year earnings. When it comes to paying dividends, you can go in, whether it's CDA eligible or ordinary dividends, and you can pay dividends in a number of ways. You can click Edit in Table, put in a specific amount. For illustration purposes today, I've selected indexed, put in $20,000. The software automatically indexes those dividends into the future. You can pay out all the dividends each year, just the cash that's available each year, clear the NERDTOH account, which is, quite common. Take any of those sorts of approaches. And then once you've done that, then you'll see the dividend payment method, whatever dividends are going to be paid, what cash is available, and the cash payment made. And I just want to point this out because it is possible to declare dividends, even though there isn't cash, and pay those dividends by way of a promissory note, which means the shareholder, let's say somebody in VisionWorks, will not receive the cash, but will have to declare the dividend for tax purposes. So they're not going to get the cash, but they need to declare the dividend. But then later, the promissory note can be paid off, in which case they don't need to declare anything for tax purposes. It was previously declared, so they'll receive that dividend without any tax consequence, as a result of the payment of the promissory note. And then when we go to the payment to shareholders, there are different choices here, but the default is to pay declared. In other words, we're declaring a dividend and we're paying it out. So let's have a look at the other side of the coin, which is looking at linking this back into VisionWorks. So in VisionWorks, I have a solution called Link to CW. And all I need to do is go to the import-export page, select CorpWorks Exchange, select CorpWorks, go in and notice, please, that what you need to do is open this CorpWorks list and link Bill Smith in CorpWorks to Bill Smith in VisionWorks. I can also, by the way, put in any salary that's being paid. And then on the Shares Debt tab, I indicate what it is that Bill owns. So Bill owns the Common A, he owns the preferreds, and he was also the person that funded the company with that $100,000 loan. So now when I click OK and import everything and go to Bill's tab, let's go to entries. What we can see now is that he owns the Common A, there are his shares. He owns the preferred, there are the 10,000 shares, and he has a link to that $100,000 loan. And because we're paying those dividends out, then when we go and have a look at the dividend flow, the sources, we can see the private company dividends of $20,000 a year that we had declared in CorpWorks. This is not refreshing. Must it be the resources of the computer? So with Zoom running, it sometimes happens. So we can see those dividends being received in VisionWorks that we had declared in CorpWorks. What I want to do next, though, is I want to go back and have a look at the auto withdrawals feature. So I've set up a new solution in order to do this. So in CorpWorks, I'm going to switch solutions to one that I just called auto. And I've set up a parallel solution in, notice no preferred shares, by the way. I've set up a parallel solution in VisionWorks which I've also called auto. So we'll link those two together. And in order to do this auto withdrawal, which is what we're going to be looking at, what I need to do is I need to link VisionWorks and CorpWorks together. In other words, CorpWorks and VisionWorks can't communicate with each other until I've indicated that Bill's the shareholder of CorpWorks. So in VisionWorks, if we go to the Entries tab, you can see the common shares that Bill owns. So to repeat, if I'm going to do auto withdrawals, what I need to do is to go to the import-export page, import from CorpWorks, and make sure I've set Bill up as the shareholder of those shares. Once that link is being made, then CorpWorks and VisionWorks can communicate back and forth. So I want to go to auto withdrawals now and explain how this works. So I've selected auto withdrawals. I've clicked calculate for linked solution, and I've linked the CorpWorks plan to the VisionWorks plan. Only Bill is the shareholder. And when I click OK, what's going to happen is that CorpWorks is going to send a message to VisionWorks and ask, how much money do you need each year of the plan in order to top up your bank account in VisionWorks so there's enough in it in order to pay your expenses. And VisionWorks sends a message back to CorpWorks and says, this year I need X, next year I need Y, and so on. And then CorpWorks sends that money across to VisionWorks. VisionWorks does a tax calculation on the income, sends a message back to the CorpWorks and says, you're going to have to gross that up depending on the type of dividend being paid, because I'm going to have to pay taxes on it. So if it's a CDA dividend, of course, there's no gross up. If VisionWorks needs $1 and CorpWorks sends $1, then that's all that's necessary. But if we're talking eligible and ordinary dividends, then clearly when CorpWorks sends a dividend over, VisionWorks will send a message back understanding the type of dividend and then saying you need to gross it up by a certain amount so that after tax, I have the amount of money in the bank account that I need to pay my expenses. And you'll notice, by the way, you can include or exclude different types of dividends. You can change the order just by selecting something and then using these arrows. Do not select ERD-TOH and NERD-TOH. It will limit the dividend payments just to them. So you want to be able to pay out whatever's necessary, just select the check boxes. And also, I want to caution against including CDA dividends in this payment. And the only reason is that when I talk to some of our accounting clients, what they tell me is that filing with the CRA to understand exactly what's in the CDA account and so on is actually an expensive process. So accountants don't recommend paying CDA dividends out annually for that reason, but maybe something to pay like every 3 to 5 years just because of the cost involved. So what you might do is you might do auto withdrawals with the eligible and ordinary dividends, not with the CDA, and then at some point, just go into the CDA table and pay out a separate amount of dividends. Now, the other thing I want to point out, though, is that what we're seeing here is the amount that's required. And required does not necessarily mean that the cash is available to make the payment. This is just establishing how much would need to be paid in order for VisionWorks to have enough in its bank account to meet the expenses. So just keep that in mind, because once that's determined, then what happens is CorpWorks will pay out what it can based on the cash in the till. And again, you can see the dividend payment method. We could have a mix. So you can see here that there is a little bit in the CDA account this year. So in order to pay out what VisionWorks asked, it paid some CDA, and then it paid the balance in ordinary dividends so that VisionWorks received the total that it required. So there can be a mix in different years. So, CorpWorks will pay out what it can from, the account up to the amount that's available to it. And then if the amount that it has to pay out exceeds that, it will then go to the next account and pay that out. So let's just go back to VisionWorks. So now that we've done that, we can go to our auto withdrawal. And again, remember, there's the little flashing indicator just to remind you that a change is being made. All we need to do is just click it, say, yes, we want to re-import, and then just click OK. And then what will happen is the dividends will now get paid across. So we can see the link here. And if we go to entries and net cash, and that dividend is being paid in 2025, which is when Bill first retires. The one other thing that I just want you to notice, and Sue, by the way, is the beneficiary of Bill's shares. So on Bill's death, Sue will inherit those shares and will continue to receive whatever dividends. And Bill Jr. is indeed her beneficiary. So on her death, Bill Jr. will continue to receive the dividends. The one thing I want to point out, and something that I did in this file in order to create a need in VisionWorks for dividends to be paid, was that I went into withdrawals, and for Bill and Sue, I deselected all of these checkboxes so that what I want to do first is not rely on the non-reg portfolio, the RSPs or TFSAs. I want to take money out of the holding company in order to meet the expenses in VisionWorks. So you can see that's flat. Bill's running a little bit of a shortfall in some years, but Sue's running a bit of a surplus. So overall, things are running at above zero. Just while we're here, when we look at net cash, you'll see some years it's a little positive, some years it's negative. When we do the auto withdrawals from CorpWorks to VisionWorks, we're not aiming to make this exactly zero every year. In fact, we're just aiming to make it $100 or less. Now, the reason is in some years it's a little more than $100. And that's because in CorpWorks, we're starting with a wide open field. CorpWorks is saying, how much do you need? VisionWorks is sending back a message. CorpWorks is sending out what it can, but we limit the number of iterations, the number of times that's done to figure out, the exact amount, because otherwise to get it to zero, there could be many different recalculations that would just unnecessarily take time. If, however, you've already done an auto withdrawal in CorpWorks and you want to refine this a little, do a second auto withdrawal, because now when CorpWorks and VisionWorks are communicating how much money do you need, they're starting from a narrow field based on our first iteration. So the first iteration is very wide open field. It'll get it close. But if you redo it, the second iteration, starting from a narrower field, will actually get it, much more refined. So you can see, all of that is being transferred over correctly. But the point that I wanted to make was, if I look at income assets, you can see that there's a shortfall here. The value that you see in income assets is the value that still exists as the value, for instance, of the corporation itself. So there's still money in the corporation. Let's go back to equity. There's still money in the corporation that could come over, although that money might be intangible assets like real estate or the cash value of insurance policies or whatever it might be. So I've done this intentionally where I've got a little bit of a shortfall, because what I wanted to do was drain the corporation first. And then once the corporation is drained, I might want to come in, for example, and drain money out of the RRSP to try and make up that shortfall. So now I I've selected the RRSP for Bill and Sue, and we're still not close. We've improved things a little bit, but I might have to select the TFSA, for example, for both of them in order to finish topping up the bank account in VisionWorks. So you have a number of choices. You can tap out TFSAs and RSPs first and then bring money in from the corporation, or you could, for instance, go in and tap out the corporation first and then use RSP and TFSA money. The money in there is compounding tax-free. So, there's something quite powerful about all of that. Or if you wanted to do a blend, I could set the auto withdrawal rate, let's say for the corporation, out to something like 75. So I'm riffing at 65. That's what withdraw means. When are you going to convert to a riff? But I'm not telling VisionWorks to auto withdraw until 75. So what I could do is I could have a spread here, and then I could go to the RIF, LIF, LRIF withdrawals entry, and I could manually put in however much I might want to withdraw from the RSP prior to Bill's age of 75. So I could do a bit of a melt, and then I could go back and do an auto withdrawal from the corporation to make up the difference. So there are a few different ways that you can do things. Let's go to CorpWorks, and we'll just talk briefly about insurance. Actually, let's jump back to the entries panel and have a look. We'll go to DEF. So when it comes to an insurance calculation, of course, there's a life calculation, but there are also DI and CI calculations, and you'll see different types of insurance. So there could be business overhead insurance. If Bill became disabled and couldn't work, how much insurance would the company need on Bill, the company receiving the benefit, in order for the company to carry on? It might have to hire somebody to replace Bill. That person might not be familiar with the different customers and so on. So there could be some loss there, all of which you could model in an insurance scenario. So if we go to the insurance tab, you can see we can select the person that we want to look at the insurance, and then we would go to life, and we can talk about Bill dying today, do an insurance calculation. Shareholders agreements could be in place. We could be redeeming shares, buying shares, any of those sorts of things could happen. So, what would the insurance requirement be? And then we also would have the disability need and a critical illness need. So we can go in and do those calculations. If you get into the insurance calculations, I would imagine that it would be something where we would have to run through it together. It sort of depends on the circumstances. And it also depends on whether there are shareholder agreements in place and so on, in order to determine, exactly how all of this is being managed. But again, within the insurance sub-solution, just like in VisionWorks, what you would do is you would go in the sub-solution, click continue, and you would make some changes. So, for example, we might want to go in and say, if Bill became disabled, then our expectation would be that revenues would drop off. So we could go and put in what we suspect might happen, and then we might have the revenues going back up to what we expect in the future, keeping in mind that we can now change that graph type. So we could have a sudden drop in revenues if Bill became disabled. He has the ties with the company's customers, and then we could have somebody hired. So we would go in now under expenses, and we would hire somebody else to come in and take his place, which we could say, and we could set that person up as a key employee. So we would have that additional cost and maybe related costs, like different benefits that the employee might have. And then that would allow us to figure out in the sub-solution, what kind of disability need would be required in order to compensate for all those changes within the company. But it's the same general concept. If somebody becomes disabled or critically ill or dies, there's going to be a change in the business. We can go in and imagine what those changes might be, and then that would allow us to do the insurance calculation. But again, I think it's one of those things that at least the first time you do it, you would likely want to have a conversation with us about that. So those are the things that I wanted to cover with CorpWorks today. Again, just the things that make it different when it comes to actually modeling things, whether it's a business or whether it's a portfolio or whatever it might be. Let me just switch to the main solution. Then and we'll go back to the gross sales. Then the specific types of entries are essentially exactly the same as they are in VisionWorks. So really, it's just a matter of understanding the about page, how to set the corporation up. Then when it comes to solutions, things like what capitalization method are you going to use? Are there going to be any changes in the capital structure? And otherwise, basically, it's really just setting up the payment of dividends and then linking everything together. So we'll be posting the recording. Monday, we're going to do exactly the same, but we'll go through TrustWorks. That will complete the webinar series that we've been doing over the last couple of months, which is intended to look at basics. And then what we'll be doing in a couple of weeks is we'll be starting a whole new webinar series where we're really going to talk, now that we've covered basics, mechanics, we're really going to talk about life planning and what are the elements involved in it. So thank you for your time, and I hope you have a great weekend.